Happy Thursday, guys. I got to be honest. I don't know if I push record, so we're doing a second take just in case on the first one. So here we go. This is, had a round of practice. Let's go through this, guys. Rates, I'm surprised. I thought they'd be higher, to be quite honest. We're seeing rates in the sevens. We sell directly to Fannie Mae, directly to Freddie Mac, and we're seeing rates with 7. So for them to say 0.694 with only 0.9 fees, that seems low to what we're seeing right now, but there you go. That's what they posted today on FreddieMac.com. You can see in this chart, again, down is bad, right? When the chart goes up, that means lower rates. This way means higher rates when it goes down. You guys can see we're at the lowest we've been, which means the highest rates we've seen. So they're in the 7s. I hate to tell you that. I hope, and you guys can see this little red and black line down here at the bottom. It means we're oversold. I think and hope maybe we might find this bottom. They drift a little higher. I've been saying I do think rates are going higher for the next 60 to 90 days. That's my personal opinion. I think November's inflation reports are going to come out showing inflation's flat. I think December is going to finally show that maybe we're starting to make some headway and it will come down. And I think from there through Q1 of next year, I think inflation starts to show a sign of coming down. So the Fed hopefully can and will be increasing rates in their next 2 meetings in November, December. I hope they do 0.75, and that'll really prove it to where by Q1, all those rates are starting to have some impact on the economy. I think that's when inflation comes down, our rates should be coming down. So I'm hoping, and it's not telling you, it's crystal balling here. I think rates go higher. I think they do drift here. But one thing to note, look at that one candlestick, the skinny one from last week. You see how that one little skinny red line, and the day ended up being like no big deal in terms of like the start and the finish. But what the volatility was going on in there, it was the UK. And I'm going to show you that in a second. The 10-year treasury, guys, it's typically opposite of mortgages. So as this goes up, right, this is not a good thing for us. And the good news, like I said, we're up here at 420. I think and hope maybe that ceiling's going to hold and maybe we drift back down, which would increase or improve our rates in the near future. So we shall see what happens with that 10-year treasury. And the S&P, I do think will probably oscillate somewhere in between, that 3,800-ish. I am personally, you guys do whatever you want, consult your financial advisor. I am starting to layer in some money over the next 4 to 6 months. I think the stock market is known to be a 6-month fortune teller. So it forecasts 6 months from now. I think 6 to 12 months from now, things are going to be better. And I think there's an opportunity to make some money. So I've started investing and I've been doing it since June. So I've been throwing some money in there, but I'm going to start just doing a little more each month and start layering in over the coming 4 to 6 months. That's my 2 cents, and we'll see what happens. The Economist, this is funny. I've seen headlines. It's a tale of 2 cities. For these next couple of slides, I've seen headlines saying, "Oh, economists now expect a recession." Look, I get it. All right, the National, Bureau of Economic Research, they technically define recessions, but the layman, the generic definition is 2 consecutive quarters of negative GDP. We've already had that. We're probably already in a recession. A lot of times you don't know it till after the fact. So then the question is, what does the Fed do with their rates? As I mentioned, I think November, December, I hope they keep their foot on the pedal and go 0.75 in both of those meetings. I don't think they're going to need or want to cut rates till the very end of Q3. So it looks like other people are agreeing. This is from the Wall Street Journal survey of economists. So they think all Q4, Q1 I'm good with those time periods. I think the people that think they're cutting in Q1, Q2 of next year are crazy. So there you go. So I think there's some nuts out there. Speaking of nuts, that's mean, shouldn't say that. But Liz Truss resigned as the UK's prime minister. So remember that little long candlestick, the red one that was like that wild day from last week where we had to make like 2 days in a row of videos to just prove what was going on. This lady was basically the match that started that fire. So I don't think I realized she was only in office for like 45 days or something like that. So it's wild, but she resigned. I don't know about you, but I can't think of many other folks that held the job for less than 45 days that impacted the global markets like she did, which is nuts. So we'll see what comes up after that. Hopefully the markets start calming down. Tale of 2 cities. Brian, the CEO of Bank of America, says consumer is amazing. Jamie Dimon, I've seen headlines of his for the last couple of weeks and months. Jamie Dimon of Chase is like, oh, things are going to be really terrible, nasty. He's using some scary language. Brian seems to think things are good. He's like, man, the consumer's strong. The credit remains pristine. That last bullet point, credit remains pristine. So we don't want a strong consumer. I hate to say that, and I'm not trying to wish ill will, but the Fed's trying to squash spending. They're trying to kill demand by raising rates. So a healthy consumer who has money is going to keep spending. So hopefully the truth is somewhere between those two, between Bank of America and Chase. We'll see. Guess what, guys? You're looking at the worst portfolio returns with two exceptions since 1926. So if you had because bonds and mortgage, or pardon me, stocks and bonds are getting beat up, which is wild because it's usually, it's one or the other. And typically when stocks don't do well, something safe like a bond is going to be good. But this market is so nutty and so crazy that it shows you that if you had a portfolio of 60% stocks, 40% bonds this year for 2022, there's only two worst times, 1931 and 1974. Holy smokes. So take a look at your portfolio or don't, and just realize, guys, it's not going to be like this forever. Stay the course, keep investing consistently over time, and long-term, you're going to be fine. But man, what a beatdown. These next two articles that I'm going to show you are just like, this is how crazy it is. And we got to make sure we educate our buyers and the people looking to buy. It says that there's been a single family home sales decline. That doesn't mean price. That's what these headlines can be confusing. Like, look, activity is down. There's no question. Rates are at a 20-year high, demand's at a 20-year low, and there's certainly way less volume going on. Matter of fact, the projected volume for 2022 is 1.6. That's half of what it was during COVID. So yes, activity is down. Why do I think it's still a good time to buy? Check it out. Fannie only expects the average price home to decline by 1.5%, and that's nationwide. Dallas-Fort Worth is awesome. We got people daily that I talk to coming to move into Dallas-Fort Worth from out of state because Texas is awesome. Here's another example of just stupid headlines. Pricing, asking prices tumble. Okay, 0.77%. I get for 1 month, that's not ideal. But to say they tumble later on in this article, check it out. The price of homes, the median price is still up 9% year over year. So let me say that again, 9% higher. So on a $400,000 home, that's 40 grand that somebody has made on that home. Home ownership is still strong. The demand is still there. Yes, activity is lower, but so is the amount of homes that they can buy. So it is a good time to buy. And here's why, guys. Utilize a 2-1 buy down. If you're a builder watching this, hold your prices, because you know as well as I do, if I bought a house for 400 grand across the street and I now see you selling it for 390, I think I just lost 10 grand and I overpaid and I got screwed. Hold the line, give away the concessions, give away 10 grand because they never see the closing disclosure. The consumers don't see it. The realtors don't see it because the realtor is going to say, oh man, that community is on decline. They just sold 3 houses at 390 and I sold a house there 6 months ago at 400. Hold the line, give the money away, concessions, use the 2-1 buy down. What most people may not know about a 2-1 buy down, let's pretend there's 10 grand of cost that a builder can say, here's 10 grand, go get a 2-1 buy down. So Mr. Smith, I know you want to buy this home. I can go back in time and get you a rate $500 lower than what the next guy's going to have today because I'm going to give you 10 grand. With that 10 grand, 6 grand of it, so 500 a month lower payment, guys. So let's say rates are at 7%. Homeowner can move in year 1, they make a payment like it's 5%. That's $500 lower per month. So 6 grand of that is being supplemented by the builder. Year 2, in my example, this isn't always working out this way, but it's pretty close. Year 2, it's 4 grand, where the buyer now pays the 6%. That's the 1 and the 2-1 buy down. So that 6% payment's about $250 lower than what they could or would be paying. But let's pretend 12 months from now, I'm right. Rates are down. They refinance. Guess what? If it's 12 months to the day and there's 4 grand left in that account, that 4 grand goes towards their principal. It's a principal reduction. It's not money lost. So think about that. If they refinance and the costs are 4 grand on the refi, it's like it's free. And then they get to keep that, whatever the rates go to. Let's say they go to 5, they get to keep everything, but it gets them in the home today and they're not competing with 20 other people trying to buy homes. This is a great time to buy. Educate the consumers. Get them over to us. We'll be happy to teach that and coach them through that as well, guys. Lastly, if you're a boss, if you have employees, anything like that, this was a great article. Where is it popping up? There's some verbiage that's supposed to pop up here. Okay, it didn't, but I can't. I'll go back because it's worth doing, guys. This article by Steve Jobs, I loved it. Mark Pfeiffer, Mortgage Mark team. Our belief is that an A player is somebody that constantly wows you. The B players are just the steady eddies. We all need them. They're great. And then the C players are the dangerous ones. They can sometimes wow you, but they're really inconsistent and they let you down too. Steve Jobs has a different definition. In his, oh, good grief. in this article, and I would highly recommend you guys read it. I'll make this URL bigger for you. It is a great article. His A player definition is different than mine, and that's cool, and I like his. You can see it down here. It's an A player. It says that they can have a 90% success rate of doing something that only 10% of the population can do. I thought that was really interesting. So here is that URL if you want it. Let me share my, oh, I am sharing my screen. There you go. I'll put it up here. You guys can see it. It's a great, great, great article. I really enjoyed reading it. Hope you do too. Appreciate you guys as always for hanging out with us and watching. And if you need anything, let us know. And I appreciate all of you. Have a good day. Bye.